Hey everyone! In this video, I'm going to share 6 truly passive income ideas for busy professionals. These are effortless income streams. They can make money while you sleep, helping you retire early and giving you the freedom to live life on your own terms. If we haven't met, my name is Idan. I went from being a struggling single mom to a multimillionaire in my 30s. During this time, I spent over a decade working a corporate job, but honestly, I wouldn't be where I am today just from earned income. Passive income played a huge role in getting me here, and I want to show you how it can work for you too. I'll be ranking each of these 6 ideas using 3 key factors. First, upfront cost, how much money you need to get started. Second, potential returns, the long-term earning power. And third, simplicity, how easy it is to manage and how passive it really feels. All right, let's dive in. First, startup investment. If you think investing is only for venture capitalists or wealthy accredited investors, think again. Everyone now can invest in early-stage startups through online platforms. Here's how it works. If you're in the US, platforms like Start Engine, WeFunder, and Fundable let everyday people invest in startups and growing private companies. In the UK or Europe, Crowdcube does the same thing. You can buy shares or other equity in these companies, sometimes starting at just $100. If the company grows, gets acquired, or goes public, you could see big profits. Plus, you get that community feeling, backing companies you believe in, and sometimes getting perks like discounts, early product access, or investor-only benefits. Some platforms like Start Engine even let you resell your shares. However, do your own research. Always evaluate the company, review vetted funding proposals, and make well-informed decisions before putting in your money. Here's how I rank startup investing. It has low minimum investments. Many offerings start at $100 to $500, and platforms like Crowdcube can be as low as €10. About profit potential, some companies can grow big, get acquired, or IPO, but it is high risk, high reward. You could lose your entire investment, so I give it a 3. It also does not need much effort. Other than your initial research, there's no ongoing work required. This passive income stream is great if you want access to early opportunities and are willing to take on high risk. But since startups fail often, so never invest more than you're okay losing. One strategy is portfolio diversification. Spread small investments across multiple startups. If just one hits it big, it can make it all worthwhile. One more thing, most startups don't pay dividends. They reinvest profits, so you usually won't get regular income. Your gains come only when the company is acquired or goes public. If investing in startups feels too risky and you want a safer way to earn passive income, consider a high-yield savings account. A high-yield savings account is basically a bank account that earns interest, often much higher than a regular checking or savings account. By simply putting your money in the bank, you start earning passive income. The returns aren't huge. Right now, you can earn up to about 4 to 5% APY as of the day I'm recording this video, but the benefits are clear. First, it is safe. You know the return rate ahead of time. Second, it is flexible. You can access your money at any time. Personally, I have 2 high-yield savings accounts. One holds my emergency fund, money that sits there growing but is always accessible if I need it. The other is with a different bank and works like my checking account. I use it to get paid or pay bills. Compared to a regular checking account, any balance in the HYSA earns up to 5% interest, so it's much better than just leaving the money in the checking account. Here, you can see some highly reviewed banks and online platforms to consider for HYSA. To choose the right one for yourself, you want to make sure it's FDIC insured. That means the first $250,000 of your money is protected if the bank ever fails. Also, if you plan to use it like a checking account, check that it allows quick transfers with no limits, so you can pay bills easily. Here's how I will rate this one. It's the easiest to get started. You don't need much upfront, and many top online banks offer accounts with no minimums to open. Its growth potential is moderate. Investment is very safe, but returns are modest compared to other investments. But this one is truly passive. No effort whatsoever is required at all. Just open the account and deposit money. Before we move on to the next passive income idea, if you're enjoying these tips, make sure to like and subscribe so you don't miss any future videos on money, careers, and personal growth. Okay, if 5% a year isn't enough for you and you want something more certain than startups, here's another strategy. Buy a local business or franchise. A common mistake people make is thinking you need a big idea or a tech startup to get rich. In reality, wealth isn't just for Silicon Valley. Buying a profitable, boring business can be more lucrative and less risky than chasing the next unicorn. The idea is simple. You buy a business, then hire competent people to run it for you. You collect the profits while they handle day-to-day operations. If done right, this can free you from your 9-to-5 job, give you passive income, and even help you build generational wealth. In the book Main Street Millionaire, How to Make Extraordinary Wealth by Ordinary Businesses by Cody Sanchez, she emphasizes that small business acquisition is one of the fastest ways to wealth. For example, many successful businesses are run by retiring owners who are willing to sell for a reasonable price. These businesses already have a proven customer base, steady revenue, and smooth operations. You step in, hire the right people, and essentially become a silent partner earning passive income. The key here is to focus on essential service businesses, simple, predictable, and always in demand. For example, laundromats, car washes, HVAC companies, cleaning services, pest control, and many more. They might not be flashy, but they make steady cash flow year after year. If you say, I don't have enough money to buy a business, well, there are creative ways to finance a deal without using all your own cash. For example, you can use seller financing, which means negotiating with the owner to finance part of the purchase price. Or you can use SBA loans. Those are low interest loans from the Small Business Administration. You can also bring in investors, including friends and family, for equity, or use the business' own cash flow to pay for itself. Some people even pay the owner based on future profits to reduce upfront risk. When looking for a business to buy, focus on 3 things. First, strong cash flow and easy operations. Second, positive and stable EBITDA. And third, recurring revenue and repeat customers. You want to avoid businesses that are overly complicated, require constant owner involvement, or have unpredictable cash flow. Where to find these businesses? Well, you can go to online marketplaces like BizBuySell, BizQuest, or Flippa. Here's how I would place this strategy in the chart. You do need some upfront cost, but it can vary, and some deals are accessible with creative financing, so I give it a 4. Earning power of this one is high. Profitable businesses can provide strong, steady income. In terms of simplicity, you do need to do your own homework and choose a business. Also hiring managers, but it's mostly handoff once set up. This next passive income stream is dividend-focused index funds. If you want decent returns with almost no effort, this one is worth a look. Here's the idea. When companies share a portion of their profits with shareholders, those payments are called dividends. Dividend-focused index funds track a bunch of companies that pay steady or growing dividends. Think big names like Starbucks, Pepsi, McDonald's, companies that regularly share profits with investors. The beauty? You get steady cash flow without ever selling your shares. When picking a fund, here's what to look for. First, dividend growth funds. These funds focus on companies that consistently raise their dividends over time. They might pay a little less now, but your income grows every year. For example, Schwab US Dividend Equity ETF or SCHD and Vanguard Dividend Appreciation ETF or VIG are both good options. Second, check the expense ratio. Look for fees lower than 0.1%. Low fees means more of your dividends stay in your pocket. Third, diversification and holdings. Some funds are broad, some are concentrated. Broad means lower risks. You can also increase diversification by going with funds like Vanguard International High Dividend Yield Index Fund or VYMI for international dividend paying companies. Most dividend funds yield 2 to 4% annually, and they are usually paid quarterly. After dividends are paid, you can either reinvest dividends, which is great for long-term compounding, or take the cash if you need income now. Here are some popular funds to check out. Okay, let's come to my ratings. Starting investment can be low, even $100 or whatever fits your budget. The long-term returns is decent. As you can see here, total returns over the past 10 years for some of the funds I mentioned are around 10 to 12% annualized. And it is super easy to set up. Open a brokerage account, invest, and mostly forget about it. If you do decide to buy these funds, one tip is that these funds go up and down, so think long-term. Don't try to time the market. Over time, dividend-focused index funds compound. This is about as close as you get to earning money while you sleep. The next one is real estate investment trusts or REITs. If you want exposure to real estate without buying property, these are great options. REITs are companies that own, operate, or finance income-producing real estate, things like apartments, shopping centers, office buildings, warehouses, or even hospitals. Instead of buying property yourself, you can invest in a REIT and own a slice of their real estate portfolio. REITs are great in a lot of ways. They are are low maintenance. You own real estate passively without managing properties. They offer high dividends. By law, REITs must pay at least 90% of their taxable income to shareholders. That means they usually yield 3 to 6%, higher than most dividend-focused stocks. You also have liquidity to your investments. REITs trades on the stock exchange like stocks, so you can buy and sell easily. You can also invest in different types of real estate without owning each property yourself. Here are some examples of individual REITs. You can buy a little of each to diversify risk, or invest in REIT ETFs like these for instant diversification. Here's my take for REITs on the chart. It's very accessible and can be very flexible depending on how you want to invest. As little as $10, you can get started. Their growth potential is also good, with strong dividends but moderate price growth. In terms of ease of doing, just buy and hold can be easier. One thing to keep in mind, REITs can be a little bit volatile. They react a lot to interest rate changes and the overall economy. Take retail REITs, for example. They got hit pretty hard during COVID lockdowns. That's why a buy and forget approach usually works better. The last passive income idea here is robo-advisors. If you're just starting out with investing, this is a great way to get started. Robo-advisors are digital platforms that manage your investments automatically. They use algorithms to pick and balance your portfolio based on your goals, risk tolerance, and timeline. Essentially, you answer a simple questionnaire and the robo-advisor does the rest. No human advisor required. Robo-advisors have a lot of benefits. For example, it is minimum effort. Your money is allocated across low-cost ETFs, including stocks, bonds, and sometimes REITs. It is lower in its fees, usually 0.25 to 0.50% annually, much cheaper than human advisors who charge 1 to 2%. Its ease of use is high. Just answer questions about your goals and risk level, and the platform does the work. It also provides automatic rebalancing. This keeps your portfolio on target without manual trades. Apart from that, some robo-advisors automatically sell losing investments to offset gains and reduce taxes. Here I listed some popular robo-advisors. Finally, let's look at the ratings. Starting investment is easy. Anyone with $10 to $500 can start. About potential returns, depending on your risk allocation, annualized returns can range from 6 to 10% over the long term, similar to a broadly diversified stock and bond portfolio. And robo-advisors are hands-off investing with automatic diversification, rebalancing, and dividend reinvestment. It is a perfect strategy if you want passive investing without the headache of picking individual stocks or funds. If you want passive income with minimal time investment, these strategies let you earn money while doing very little. They're hands-off, easy to manage, and can help you build long-term wealth and financial freedom. However, this video is for educational purposes only. It is not financial advice. Always do your own research and consult a professional before investing. If you enjoyed these tips, you might like this video as well. I will see you there.